Hello, and welcome to the sixth episode of our new monthly podcast series, Market Matters. Each month, we'll bring you big picture insights from leading investment specialists exploring the opportunities and challenges faced by investors in today's markets. Today, we're joined by Megumi Takayama, a portfolio manager and analyst at Chikara Investments. Megumi developed her career primarily in equity sales at Nomura and SMBC Nikko, where she gained extensive knowledge of the Japanese equity market. She joined Chikara in 2018 and is a member of the investment team for CCJI Japan Income Growth Trust plc, which has the ticker CCJI, as well as the Chikara Japan Income and Growth Fund. CCJI invests in equities listed or quoted in Japan with the objective of providing shareholders with dividend income combined with capital growth. Its investments cover three broad buckets, which are dividend growers, companies with stable yields, and special situations, which are where the managers have identified the potential for change in management attitudes towards shareholders. Megumi, thanks for joining me today.
Thank you for having me today.
Can we just start off? Can you just give us a bit of insight into your background as a portfolio manager and analyst first? How did you get into the investment industry?
How I got into the investment industry, that goes back to when I finished my postgraduate study. I joined Bloomberg for a graduate training scheme. During that main program, we were all given opportunity to explore various financial products, and I somehow developed my interest in stock market. When I saw the real-time share price movements with lots of news going around in the office, I thought it's very strange things to say, but I felt the stock market is like a big wave. It's so powerful and it's in constant motion with price movement, and that movement can be unpredictable. And I suppose Bloomberg data or financial media can help us making the unpredictable more predictable. But I decided to make a career transition into sales side to ride the actual wave to paddle. And Richard Aston, he is a lead portfolio manager of our fund, and I have got to know him as my institutional client during my sales side career. I became quite familiar with his investment philosophy and process, and I also knew exactly what sort of stocks he was looking for because I used to attend various corporate meetings with him. And in 2018, I grabbed the opportunity to join his team as an investment analyst at Chikara. This is how I broke into buy side world. And now we are the team of three. We had a new addition to our team actually in October last year, Theo Wild as an analyst, and the three of us are currently working on this total return strategy as a team.
And you've been working within Japanese equities for almost 15 years now. I just wanted to ask what the biggest change you've seen kind of within the markets in Japan since then.
In my view, the biggest change was actually the increased focus on corporate governance reform. In the past, Japanese corporates often prioritized long-term relationships over shareholder returns. This was sometimes resulted in less transparency and accountability compared with Western markets. But over the last 10 years in particular, Japan went through a significant transformation. It started specifically in 2013 when Prime Minister Abe started the reform, which is called Abenomics policy. Corporate governance code was introduced in 2015, and the first edition of Japan's stewardship code was introduced in 2014. And the various measures have been implemented by Tokyo Stock Exchange. This includes stricter listing requirements, better disclosure rules, and initiatives to promote capital efficiency. And I think good progress been made over the last 15 years, but there is still a room for improvement, which means further upside for investors like us.
Have the corporate governance reforms we've seen over the past few years had a positive impact from your perspective as a shareholder in Japanese companies?
Yes, definitely. These reforms have made Japanese companies more transparent and focusing on shareholders' interests. Better governance means better financial performance. Therefore, the stock are traded on higher multiples. And improved capital efficiency means more dividends and share buybacks to reward investors. These are all positives news for shareholders. And as a recent trend, you might have come across news headlines talking about Japanese companies unwinding cross shareholdings. This should be seen as one of the changes in companies' practice in response to the governance reform. And what does it mean then? People think. Cross shareholding is an arrangement where companies own shares in each other. So I own a stake in your company, and you, in return, own a stake in my company. This is a defining characteristics of the Keiretsu system in Japan. And the Keiretsu is a business network. For example, Mitsubishi, Mitsui, and Sumitomo Group. And the companies within that group help each other. Helping each other or maintaining the stability is far more important than financial merit. So this is a relationship element I mentioned earlier. The relationship is so important that shareholder interest may not be a company's primary concern. So, what's the rationale or benefit of cross shareholdings? And the first point is it can be used as a defense measures against hostile takeovers because it makes it difficult for hostile third parties to increase their shareholdings to a level that allows them to gain control. And its second point is it helps with a long-term stable business relationship with banks, suppliers, or distributors, but within the group. And then the third point is it supports share price in the downturn. Because of this relationship, you somewhat feel difficult to sell the shares even when the cross-shareholding partners are underperforming. So now probably you wonder, isn't that a conflict of interest? Or it sounds more like a convenient framework to help the company's management rather than the shareholders. So things are changing now. Unwinding cross shareholding, it means by selling these shares, the net proceed or cash can be used for the company's future growth. It could be used for building new factories to expand production capacity or investing in research and development for new products. These activities will boost the company's revenue while locking the money in cross shareholding that won't generate anything. So this is all positive, and alternatively, cash can be used to buy back shares, which will boost ROE and EPS. Or cash can be returned to the shareholders in the form of a dividend, which will be all welcomed in our view. So these are all positives for shareholders.
I guess we have kind of witnessed recently the return of inflation during the post pandemic period after decades of low inflation or even deflation. How will this impact markets more broadly and companies more specifically, do you think?
Um, Coming back to inflation is more like coming back to normality. So this is a big deal for Japan. And then Japan went through a long period of deflation, and then you might be familiar with the word lost decades, starting in the 1990s. This had significant impacts on the Japanese economy and the corporate spending and the consumer mindset. This is somewhat unique, I think. So, putting this into context, in a deflationary environment, people don't see real estate as an asset. It's more of the liability because the value, doesn't appreciate, and then, it actually depreciates, and then it becomes a burden because real value of a debt is increasing. And the Japanese people love cash. you might be like familiar with that as well. But holding cash provides us a sense of security as the value of cash is increasing in real terms in deflationary environment. So this is somewhat unique. And as Japan returns to an inflationary trend, we see changes, or it will impact on the way how companies see the world. And for example, companies are increasingly raising the prices of their products or services in response to rising raw material or labor costs. And I think notable changes in this regard is price increase in transportation. And very, very weird thing, but over the last 20 to 30 years, the train fares haven't changed. And for instance, Yamanote Line base fare will be raised from 150 yen to 160 yen in March. So 10 yen increase is just an equivalent of 5 pence. So people might say, oh, that is not significant, that is not a big deal. But conceptually, this is revolutionary in my view, because it never happens like the operator, Yamanote Line operator, hadn't really done this full-fledged fare hike since 1987. So over 39 years, um, the fare stayed where it was. And also to cope with inflation, companies are also focusing on cost reduction and efficiency improvements. And this includes revaluation of supply chains and optimization of production process. So this means helping suppliers through cross-shareholdings wouldn't work going forward.
Sure. And following on from that, interest rates are now up to 0.5%, which might sound very low, but it's a 17-year high for Japan. And they are expected to kind of steadily go higher to around 1%. In addition, we have the Shunto coming up, which is the annual wage negotiations between unions and employers. It's possible after that that Japan will be seeing real wage growth for the first time in a long time. Again, how much will this have an impact on kind of consumers as well as kind of markets and companies?
As you pointed out, real wages in Japan declined year on year for 26 consecutive months until May 2024. It turned to positive in June and July briefly with summer bonuses, but it went back to the negative zone from August to October. Then it turned positive again in November. So it's quite volatile. Shinto, as you mentioned, like in the spring wage negotiations, it achieved a historical wage increase of 5.3% last year. And I suppose the market seems to expect a similar high level of wage increase this year. So it could be possible that real wages could stay in a positive territory going forward if inflation remains under control, obviously. And what's the implication for the companies? The most direct impact is a rise in operating cost. So this would be negative for companies. But we believe companies are taking a balanced approach. So, for instance, one of Japan's mega banks we hold, they increased wages for graduates by 18%. And there was a 7% increase in labor costs this year, and possibly more to come. But overall, overheads ratio went from 59% to 57%. So we think like optimization of human resources is a key, and Japanese corporates are so far prepared for the change, and then they're coping okay with it.
And looking back to corporate governance reforms, just quickly, and kind of talking to CCJI, how has kind of the corporate governance reforms impacted the investable universe that the trust can pick from? Is there a higher number of dividend paying or dividend growing companies around now?
Yes, there are more investable companies for us in Japan, and with better outlook for earnings growth and a strong free cash flow. and competent management who is committed to increase dividends over time. So there are over 3,900 listed companies on the Tokyo Stock Exchange. We have got around 100 stocks in our watch list at the moment, but it could expand more. And within our investable universe, we also closely monitor companies which are ready for transformation. And these companies may not be up to the standard yet, but in terms of the capital efficiency or governance, but if the management is prepared to take a step forward to the change, we may consider investing in the company if the stock meets our investment criteria.
And how does CCJI balance the need to generate income from its portfolio with its dual objective of delivering capital growth?
As a self-balancing mechanism, we use three categories or buckets in terms of portfolio construction, and around 75% is the core position. And this is like, mainly the dividend payers, the companies with a consistent track record of paying dividends, ideally with a history of increasing dividend in value or payout ratio. And then around 10% is allocated for stable yield stocks, which are currently yielding higher relative to market. And the remaining 50% is a special situation bucket. And these are companies without the dividend track record, or we expect significant improvement in its operation or shareholder returns. And it will balance it out on its own.
Sure. Now, with US President Donald Trump currently threatening tariffs on lots of different countries, is there a worry over what the current US administration will mean for Japan, or do you feel that the country's in a better position to deal with these geopolitical worries?
It's a very good question. And then um, the situation seems to be changing all the time. And we do ask corporates about this question, and then corporates are reluctant to make any explicit comment at this point because no one knows what's going to happen. But in general, tariffs are negative for global growth. And a US tariff in the 1930s reduced global trade by 50% in 3 years. And Japan is geared to global trade, so this means it's negative. And by value, the auto sector appears to get the biggest impact. The majority of exports from Japan are auto sector related, but the situation is actually complicated for the fact Japanese auto companies have been investing significantly in the US for decades, and so it may not be as bad as people think. And then the tariff discussion is a political matter, and we believe and hope that Japan is in a favorable position in this regard. Um, Maybe in reality, the Trump administration will be more pragmatic, but if it does go ahead, manufacture is likely to increase US production and putting further investment and possibly price hike. And in terms of our invested companies, we tend to invest in the companies which have competitive quality of products with high margin, and we have a very diversified portfolio in different area of business. So we believe the direct impact will be limited.
And are there any sectors or companies that you guys are currently particularly positive on in Japan moving forward?
We maintain a positive view on financials. It's obviously a beneficiary of interest rate and also normalization of a monetary policy. And financial sector is less impacted by tariffs, comparatively speaking. So we maintain a positive view. And we also like selected manufacturing companies as we expect some like excess inventory to be unwind. But among all, like my personal pick is hotels actually, because of inflation, asset value will be increased. And but the labor shortage is a problem, like especially in construction sector. So supply of new hotel facilities will be limited. And unlike those food and beverages, it is easier to increase the hotel room rate, especially through dynamic pricing, which allows hotels to change their rates based on current demand. So I'm actually like quite positive on hotels.
And what do you see as the biggest risk for investors as we kind of move through 2025 and beyond?
The biggest is it's quite difficult to choose what's the biggest, but geopolitical risk in the region, like tensions with China over Taiwan, is obviously a risk. But I'm more worried about the currency because people seems to be uncertain about it and weaken. Um, and especially because increasing labor costs may um, push companies to raise prices further, in which case real wages may decline. And also yen continue to be weak against the dollars or weaker again, which could drive up domestic prices, and this will slow down the domestic consumption.
And to end the podcast on a positive note, what are the biggest opportunities through 2025 and beyond?
I haven't mentioned about geopolitical risks in the region, but if the global supply chain is disrupted, this may create opportunities for Japan. And we also believe there's a room for further improvement in corporate governance reform. So that's something we see as an opportunity.
Great. And we hope listeners found that interesting. Megumi, thanks for joining us today.
Thank you for having me.
Now, if you want to read more market insights, please check out the articles on the Kepler Trust Intelligence website and obviously give the Chikara website a read too. Thanks for listening today, and we hope to see you soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.